Meet Sarah. She was 31, married, with a 2-year-old daughter and a mortgage she and her husband barely stretched to afford. Life insurance felt like something she'd sort out later, one of those adult tasks easy to postpone. Then, her husband Marcus was killed in a car accident, and later became now. Suddenly, Sarah was staring at $340,000 left on the mortgage, $47,000 in combined debt, and a toddler who needed full-time childcare. Today, we're going to talk about life insurance, who really needs it, what type to get, and how much, because Sarah's story happens more often than anyone wants to admit.
At its core, life insurance is a contract. You pay a monthly or annual premium, and if you die while the policy is active, the insurance company pays a lump sum, called the death benefit, to your beneficiaries. That's it. It's not complicated. The question is whether you actually need one. The honest answer, it depends entirely on who relies on your income. For Sarah, Marcus's income covered half the mortgage and all the health insurance. Without a policy, that safety net simply didn't exist. Life insurance exists for one reason: to make sure the people who depend on you aren't financially destroyed if you're gone.
Here's where most people get confused. They think life insurance is only for breadwinners, but that's not the full picture. Ask yourself these questions. Does anyone rely on your income to pay bills? Do you have a mortgage, car loan, or other debt that someone else would have to cover? Would your death create a financial hardship for your family? If you answer yes to any of these, you likely need coverage. And here's something people overlook. Stay-at-home parents need coverage too. If Sarah had stayed home with their daughter, Marcus's death would still have meant paying for childcare, which nationally averages over $15,000 a year. That's real economic value that needs protecting.
Now let's talk about the two main types. Term life insurance is exactly what it sounds like. Coverage for a set term, usually 10, 20, or 30 years. It's pure protection. If you die within the term, your family gets the benefit. If you don't, the policy expires. Simple, affordable, and straightforward. Whole life insurance, sometimes called permanent insurance, covers you for life and builds cash value over time. It sounds appealing, but it costs dramatically more. A healthy 30-year-old might pay $25 a month for a $500,000 term policy versus $400 or more for the same coverage in whole life. For most working Americans, people like Sarah and Marcus, term life is the practical, affordable choice.
Here's a number that should stop you in your tracks. According to LIMRA, the insurance research organization, approximately 102 million American adults are either completely uninsured or don't have enough life insurance coverage to protect their families. That's nearly 1 in 3 adults. And the most common reason people give? They assume it's too expensive. But studies show most Americans overestimate the cost of term life insurance by more than 3 times the actual price. Sarah and Marcus were in that 102 million. They kept putting it off, assuming it would cost more than they could afford. It didn't have to be that way.
Let's look at what term life insurance actually costs. This chart shows estimated monthly premiums for a healthy 35-year-old on a 20-year term policy at different coverage levels. A $250,000 policy runs roughly $18 to $22 per month. A $500,000 policy is around $25 to $35. Even a $1 million policy is often under $55 a month for a healthy non-smoker in their 30s. These numbers come from industry averages across major carriers. For Marcus and Sarah, a $750,000 policy would have cost less than their Netflix and streaming subscriptions combined. That's the part that's hard to accept in hindsight. The cost was never the real barrier. The barrier was simply not knowing.
So how do you figure out the right coverage amount? One popular framework is the DIME method. That stands for debt, income, mortgage, and education. Add up all your outstanding debt. Multiply your annual income by the number of years your family would need support, add your remaining mortgage balance, and factor in future education costs for your kids. Another quick rule of thumb many financial planners suggest is 10 to 12 times your annual income. If you earn $75,000 a year, that points to somewhere between $750,000 and $900,000 in coverage. For Sarah and Marcus, running those numbers would have pointed to at least $700,000, a policy that could have cost them around $40 a month. 2 dinners out.
Let's put a $500,000 death benefit into real context. This chart breaks down how that lump sum could be allocated for a family like Sarah's. Roughly $240,000 covers remaining mortgage balance. About $90,000 handles outstanding debt. Another $100,000 provides income replacement for 2 to 3 years while the surviving spouse stabilizes. And $70,000 goes toward childcare and education costs. All of a sudden, that $500,000 isn't just a number. It's a roadmap for survival. It's the difference between a family losing their home and a family keeping it together. This is what Marcus's policy would have done. This is what Sarah didn't have.
Let's talk about the mistakes, because this is where most people get hurt. First, waiting. Every year you delay buying term life, premiums go up. A 25-year-old gets a dramatically better rate than a 40-year-old with the same health profile. Second, relying only on your employer's group life policy. Employer coverage is typically 1 to 2 times your salary, which is rarely enough, and it disappears when you leave the job. Third, buying the bare minimum to save a few dollars a month. Underinsuring is almost as bad as not insuring at all. And fourth, getting sold a whole life policy when a simple term policy is all you need. Always ask why you're being recommended permanent insurance before you sign anything. Here's a stat that makes the case for acting sooner rather than later. A healthy 30-year-old might pay $25 a month for a $500,000 20-year term policy. That same policy for a healthy 40-year-old, closer to $60 to $75 per month, and that assumes the same clean bill of health. If any health conditions develop in those 10 years, rates can climb even higher, or coverage could become harder to qualify for. Waiting a decade to buy the same coverage costs you 2 to 3 times more in premiums over the life of the policy. Sarah told me that's the part that still stings, not just the loss, but knowing a decision deferred for just a few months changed everything.
The good news, getting life insurance has never been easier or faster. Online platforms let you compare quotes from multiple carriers in minutes. Many term life policies today can be issued without a medical exam, just a health questionnaire. Here's a simple action plan. First, use an online life insurance comparison tool to get quotes from at least 3 carriers. Second, use the DIME method we covered to estimate your coverage amount. Third, choose a term that covers your peak financial responsibility years, typically until your kids are grown and your mortgage is paid. And fourth, do it now, not next month. This is one of those decisions where delay has a real, measurable cost. Sarah would agree.
Sarah eventually got a term life policy, for herself this time. She tells people it's the most important financial decision she's made since losing Marcus. The lesson isn't meant to scare you. It's meant to motivate you. Life insurance isn't about dying. It's about making sure the people who count on you are protected no matter what. Term life is affordable, straightforward, and powerful. Most Americans can get solid coverage for less than a streaming subscription. You've seen the numbers. You know the framework. Now it's just about taking that first step. If you found this helpful, subscribe to US Wealth Logic. We break down money topics like this every week so you can build real, lasting financial security.
This video is for educational purposes only and does not constitute financial or insurance advice. Life insurance needs vary based on your individual circumstances, health, income, and family situation. Please consult a licensed financial advisor or insurance professional before making any coverage decisions. All statistics cited are from publicly available industry sources as of 2020.